Hey guys, Daniel here. In this video, I'm going to go over why I would not buy Apple stock right now. So whenever you're buying a company, obviously you want to know, is this a good buy or is it not? And sometimes it's a little bit difficult, especially for beginners in value investing or just stock buying in general, to determine, should I buy this company or should I not buy it? I'm going to give you my approach and my way of thinking, the framework that I use to decide for yourselves whether or not a company like, let's say, Apple would be a good purchase. So I know I'm very rudimentary here, but I promise this video is going to be good, okay? So yes, I am using Paint, but I'm going to try and explain to you very quickly what determines the return of a security when you purchase it. Over the long run, on average, when you buy a security or a stock, your return, more often than not, is going to be equal to your upfront cash return, so we can call that cash return, plus your expected growth rate equals your return. Now, this is on average, okay? And like I say, more often than not. Your cash return is essentially the earnings yield of the company. So for simplicity's sake, let's just take out cash return and just replace it with earnings yield because we don't need to be too fancy. So let's just put earnings yield plus your growth rate will, over the long run, more often than not, equal your return. So let's say you get a company and its earnings yield is 5%. And you anticipate it's going to grow at 3% per year, that means over the long run, guess what your return is going to be? 8%. Okay? On average. On average. Now, how do you know that this is the case? Well, let's just look at what the average earnings yield of a company in the United States has been over the past, 100 years. We know that the average PE ratio of companies on the US stock exchange has been 15 over the past 100 or 150 years or something like that. So if we translate that into a yield, then we know that the average earning yield on a company basically is 6.7%, let's just say. Okay, so this is historically the average yield basically on companies. And we know that in terms of real growth, it's somewhere between 2 and 3%. Let's just keep it easy and say it's 2%, okay? And if we add these together, then that means we get 8.7%, right? 6.7 plus 2 equals 8.7, right? I think that's pretty easy and straightforward. Well, if you look at it, what has the average company investment, the average stock returned over the past 100 years? It's going to be between 8 to 10%, because the average earning yield is about 6 or 7%, and the average growth rate is about 2 or 3%. So if you factor it in, you're going to get that 8.7, which is your average return. So how is that useful to us today? Well, it's pretty straightforward. If we look at a company like Apple, like let's just say we wanted to do a very quick analysis to determine whether or not Apple's a good company to buy or not. The two numbers that pretty much you need to know more than anything else is what its earning yield is going to be, let's say next year. So you got to estimate, next year how much is it going to make, approximately, and what is it going to grow on average over the next, 5 years. If we know these two numbers, then we can calculate what our anticipated return is. If we can calculate what our anticipated return is, then we can compare that to other investments and other alternatives and see if it's a good deal or not, if it hits our threshold rate of return. So for a lot of people, that threshold, for example, will be 10%. So they'll want something that's going to deliver a return greater than 10% or greater than 15%. You set the threshold for yourself and determine then, is this a good investment for me or not? So let's use Apple, like I say, as an example. If we just look at, well, let's do it this way. Let's look at what the analysts, they're not always right, but for a big company like this, there's a lot of eyes on it, so we can see what they say, what they think the earnings basically is going to be next year. So they're anticipating an average earnings next year of $8.29. $8.29. So what we can do is we can take this number, which is next year's earnings, so the anticipated next year's earnings, and divide it by the current price, $221.41. And so that gives us a current yield of 3.7%. So let's go back to Paint here. Let's clear out all this junk. Clear it out. Okay. Now, we know our earnings yield right now, or our future earnings yield is 3.7%, meaning everybody's saying, okay, next year Apple's going to earn 3.7% on its current price. Okay, that's basically what we did. We can go over that again. So next year they're saying it's going to earn $8.29, and right now it's 221.42. So we can take this number and turn it into a percentage and say, okay, it's going to yield 3.7% next year, right? I think that's pretty clear for everybody. So let's go back to Paint here. Now, the second number in this equation is the growth rate, right? So we're saying next year Apple's going to earn 3.7%. Well, what's our growth rate? Growth rate is obviously very hard to know. You need to know a lot about the industry. You need to know about, what its future products are going to be, its competitors. It's not as easy as just looking at one number. But for the sake of it, what we can do is we can look at what Apple's growth rate has been in terms of its revenue over the past 5 years. Now, it's had some great years, like 2021, but most years has been so-so, right, in terms of revenue growth. Revenue growth is almost always a good predictor of future earnings growth. It's better than using earnings growth because ultimately you can only grow as fast as your top line grows most of the time over the long run. So as a proxy for future earnings growth, we can use revenue growth temporarily. Although I do recommend you definitely do your own due diligence in terms of what that future growth rate is going to be, because it's not as easy as just taking an average number, okay? You are going to have to look at industry factors. You have to look at what products are they going to be putting out. Is next year anticipated to be a big year for them, and so on, okay? But I'll leave you to do that research for yourself. I don't want to spoil the fun. So we see its median revenue growth over the past 5 years has been 5.5%. So let's just temporarily use that as our placeholder number, okay? 5.5%. So what does this mean? And using a predicted earnings yield for next year and its anticipated growth rate, which we used the 5-year median revenue growth, 5-year median annual revenue growth, 5-year median annual revenue growth, yeah. We can then calculate what our anticipated long-term rate of return is by buying and holding Apple stock, and that puts us at 9.2%. Now, what does this mean? This means, more likely than not, based off the rough numbers that we just came up with, Apple is likely to return an investor about 9% over the next 5 years or something. Does that mean that that's what's going to happen? It might return you 90% a year. I have no way of predicting the future. But what I do know is that based off of the current low earnings yield and the current low anticipated growth rate, Apple would not be a wise purchase at the current price. There may be other factors. This is not an in-depth analysis. I'm not suggesting you don't buy Apple. All I'm saying is that based off of a preliminary glance at the most important factors, which essentially are your earnings yield and your anticipated revenue growth, Apple is currently overpriced. Now let's say Apple price falls and it falls by 50%. Well, then that means if the price falls by 50%, then that means that this would be doubled. Right? Your yield would be doubled. So instead of 3.7, you would get an earnings yield of 7.4. So if Apple price fell by 50%, you would then say, well, now my earnings yield is 7.4, and I'm anticipated to grow at 5.5% per year. So 5.5. Therefore, my anticipated rate of return is 12.9%. Now, if your hurdle rate is 10%, then 12.9%, maybe you're comfortable with that margin of safety, but maybe you're not. And nobody can basically judge that for you except for yourself. So let's say Apple price falls 50%, the stock, right? Then you would, using these rough numbers here, you would be able to calculate, okay, my anticipated return over the next 5 years is 13% per year. Is that, or 12.9%, 13%. Is that good? I don't know. You be the judge. What's your hurdle rate? For me, it's not good still. But again, these are preliminary numbers. Do your own due diligence. Let me know if you have any questions. Be sure to like, be sure to subscribe, be sure to comment, say thank you for the video or something along those lines. Okay? Talk to you next time.